Very good afternoon to everybody, and welcome today to today's webinar. Certainly appreciate your patience just as we work through a few little logistical matters there. So my name is Ryan Defina, and I'm chair of the Royal Statistical Society's Finance and Economics section. And the Finance and Economics section is actually newly established following a successful 3 years operating as a special interest group within the RSS. And we're pleased to be able to contribute to the RSS strategic goals and to offer a further conduit for promotion of statistical literacy and expertise. Our group seeks to foster and develop working relationships between statisticians, economists, and other professionals working in finance, economics, actuarial, and related commercial and policy areas. And so I'm very pleased today to bring you this webinar, and it's titled "When Science Meets Finance," with our special guest, Dean Buckner. Now, just quickly before I introduce Dean, again, a few logistics here on the format. Dean is going to go through his presentation today, and I think we'll leave most of the questions towards the end. But certainly feel welcome to utilise the chat function, the raise your hand feature, and we'll do our very best to ensure that everyone has an opportunity to put their questions to Dean. An important thing just to note as well is that this meeting is being recorded, and so for those where that's a sensitive matter, if that's something you'd like to keep into account, please do so. This will be recorded and made available, so that's something to consider there. Okay, so without further ado, to our speaker. So Dean Buckner, he worked at the FSA, the Prudential Regulation Authority, and the Bank of England for nearly 20 years. He specialised in derivatives and asset valuation, capital modelling in both the banking and life insurance sector. He's now retired from the bank and seems to be predominantly involved with the UMIAS project, which seeks to, quote unquote, keep an eye on the palaces of the financial system, the independent and neutral organisations appointed to protect the public interest. So it's fascinating stuff. As a former central banker, that's really interesting, I must say. Really keen to see what Dean has to say today. I've been very much looking forward to this. I hope you enjoy the presentation. Thank you so much to Dean for taking the time. It's very much appreciated, and I'll turn the floor to you.
Great, Ryan. Thank you very much. Welcome, everyone. Thanks for that great introduction. Next slide, please. Yeah, I think Ryan's already covered that. I was at the PRA and predecessor regulators for, whoops. Can we go back, please? Sorry. Right, previous slide. Yeah, I think we've covered most of that. One thing to add, the very last thing, probably the only useful thing I ever did in my entire career was CP 1318, published by the PRA, now in the bank, strengthening, it was a paper that strengthened the capital adequacy and valuation rules applying to firms holding equity release mortgages. Next slide, please. Current work, current and previous work. I mean, there's a lot more there, but these I thought would be representative. Currently in preparation, we've had pretty much an unconditional acceptance by the Journal of Finance and Stochastics for arbitrage problems with reflected geometric Brownian motion. That's myself, Professor Kevin Dowd at Durham University, and Professor Harley at Sydney Institute of Technology, I think. And that's a pretty important paper, though I say it myself. There's been a lot of disagreement about how you price equity release mortgages, and a number of recent papers have claimed that by setting what's called a reflecting barrier on prices, that's assuming that sort of house prices will not fall below a certain barrier, then you can cheapen the value of guarantees on equity release mortgages. We have shown that violates the no arbitrage principle. That's been pretty much unconditionally accepted by Finance and Stochastics, which is a top journal, should be coming out later this year. There's also the valuation of no negative equity guarantees and equity release mortgages that I published also with Kevin Dowd and John Fry. And some work in progress. This has been very slow because it's a very difficult. We've been working on a set of papers that show you how you can price options, but without using the concept of probability. The existing pricing models assume that you have a probability distribution function which you integrate over the expected prices at maturity, at expiry of an option. We're working on a paper that sort of throws all that out of the window and goes back to much simpler principles. Next slide, please. That's just a summary of what everyone should have seen when they joined. So I won't discuss that. Next slide, please. Right. How do we define science? Next slide, please. Not easy to define. The idea of science is actually a very old concept and goes back to Aristotle and the ancient Greeks. Literally, it means knowledge, episteme in ancient Greek, and scientia in medieval Latin, which would pretty much translate to our word science. Aristotle says that science it's something that you believe and that's true, but it has to be obtained not just by sort of random belief, but by demonstration from first principles. And I think nowadays there are, I had discussions with some colleagues recently, but their understanding of science was actually quite different. They thought of it as sort of maths not being a science, but natural science being a science. That's not really the standard explanation. Generally, a set of propositions or theorems which are logically implied by a very small number of self-evident axioms, propositions or axioms. Science is not simply just a set of observations. You need a theory which relies on a small number of axioms or initial assumptions, which you then test against the observations. The history of astronomy sort of tells us that very well. Next slide, please. Sorry, I've got a bar in the way. Is there any way of moving it to the bottom? I can't see the last. Don't worry.
Don't see anything on my end.
Yeah, it's my problem. I'll look at my own copy. Right, next slide, please. Should be a slide called consensus. The previous slide. That's it. So it's generally accepted we will divide sort of scientific consensus into three sort of bits, the third of which is not consensus at all. There is the currently accepted mainstream theory, and the important thing is that all scientists, all proper scientists, accept what the mainstream theory is. They may not agree with it. Some of them may think it's wrong, but they all agree that everyone else agrees what the mainstream theory actually is. On the second row, you have sort of challenger theories, which are not mainstream theories, obviously. Again, all scientists, though they may not agree with the challenger theory, but they will accept them as being scientifically plausible and appropriate challenger theories, but probably only minority believe these. Then in the third layer, we have just nonsense and pseudoscience. All scientists would accept that nonsense is nonsense. But it sort of turns out, one of my sort of hobbies is looking at these forums where people believe in what's called alternative history, where they believe that history didn't happen at all as we understand it, but it's quite different. Also, flat Earth forums. There's been alarming growth in flat Earth sort of theory on the internet in recent years. A lot of people believe these, but again, all scientists agree, or should I say all proper scientists agree, that nonsense theories are nonsense. They're really to be debunked, although often people just ignore them as being nonsense. But significant numbers of people believe these. Next slide, should be called Science and Finance. Right. My work has almost exclusively been in financial economics and financial mathematics, and not in economics. I never studied economics. I only know it by sort of talking to people about it. Economics, I would regard, and I hope I don't offend anyone here, I regard it as a social science, a soft science. There are no generally agreed propositions in economics. There's a famous saying that economists should always have two or more hands, because you'll ask one economist and then they will say, yeah, but on the other hand, some people believe this. There's no general agreement about theorems in economics. By contrast, financial economics is a mathematical, a hard science that relies on a limited number of basic assumptions. So I would regard it as a proper science. Next slide, please. Right, the main assumptions, there are a few more than these, but the two I want to focus on here, and particularly the first, is first of all the no arbitrage assumption. We assume we do not price assets in a way that could lead to arbitrage, where arbitrage is some kind of investment strategy that guarantees a positive paper and some contingency with no possibility of a negative payoff and with no initial net investment. So it's basically it's sometimes called a money pump or money for free, money for nothing, free lunch. And financial economics assumes that if you're valuing anything or putting a price on anything, you do not price it in such a way that arbitrage is possible. And that was something that was drummed into me when I was trading derivatives way back before I ever became a regulator. Another important assumption, which I'm not going to focus on too much here, is that there's stuff we can know, there's stuff that is certain that we derive from the no arbitrage assumption. There's other stuff like what's going to happen in the future. And the assumption there is that nobody can reliably tell, and note the word reliably. Some people can make money in finance by investment. The question is whether they can do that systematically and in a guaranteed way, in a reliable way. Nobody can reliably tell where markets are going, neither benevolent government bureaucrats, i.e. regulators, nor crafty hedge fund managers, nor ivory tower academics. This is from John Cochrane. This is probably the best tested proposition in all the social sciences. And I shall assume that for now, but I'm not going to be talking about it much either. Next slide, please. Yeah, it's you know, as if to prove it's a science. We have, I hope I offend no one who was a Nobel laureate but not mentioned here. There are many Nobel laureates, but some notable ones here. From Arrow in 1972 to 1997, the famous one where Merton, Scholes, and Black posthumously received the Nobel Prize for their work on option pricing. More recently, 2013, Bob Shiller and Eugene Farmer, who actually came up with quite different theories that explain how markets work. So it's a science, in my view, and here's sort of the recognition for these scientific achievements. Next slide, please. Yeah. There are two main contentious subjects I want to talk about, one to do with valuation, the other to do with managed fund performance. I'll talk about the latter because I'm not going to focus too much on that, but happy to answer questions on that. The question is, can fund managers really beat the market? Because when you go to a managed fund, when you invest in a managed fund, you are paying a premium over what you expect to earn if you'd invested in those shares yourself, and it can be quite a lot sometimes. And that is all on the promise or the expectation that those those fund managers will beat the market. And there's loads and loads of evidence that actually they can't. Now, you might pick a fund manager who did well, and the marketing of these funds always depends on sort of picking the fund that did the best and marketing that to people. But can they reliably do that? And most of the evidence is once you've taken the fees off, they don't beat the market at all. But I'm not going to talk about that too much. I'm going to focus on the valuing of pensions, long-dated liabilities, which is a really important subject, a systemically important subject. Valuation of leaseholds, which is important for a different reason. If you've read any of the news on leasehold properties, Grenfell and all that sort of stuff, it's a hugely contentious issue of how people can actually buy leaseholds for a reasonable, a fair price. Equity release mortgage is simply an option on a leasehold, it turns out. And I will also talk a bit about liability-driven investment, which has been really in the news last year when Liz Truss and the Kwarteng budget derailed markets. Next slide, please. Right. Theoreticians have agreed on how you value long-dated liabilities for years and years. Starts with the work of Modigliani and Miller, and famously, one of the Fed governors, I think in 2001, maybe 2008, said that this is one thing where economists agreed on. It's the only thing they're agreed upon, but they are agreed on how you value a long-dated liability, i.e. a promise to pay, and that is you discount at the risk-free rate. Almost no one in the market, though, among practitioners, agrees with that method for various and basically self-interested reasons. Now, pricing assets and liabilities in different ways obviously violates no arbitrage. So if I price a balance sheet in one way, if I value a balance sheet in one way, with one company A, and company B values precisely the same balance sheet, but in a different way, in theory, there are arbitrage opportunities. Buy one company, sell the other. But because these companies face the retail market, it's often quite hard to do that. It's possible, but hard. And here we really face a problem that in the wholesale market, you rarely see arbitrage opportunities. They're just taken out as soon as you spot a mispriced security or derivative. Professional practitioners will leap upon that and arbitrage it out, as we call it. Very, very difficult to do that. But in the retail market, by contrast, because the retail market by definition is not a wholesale market, it's very hard to take advantage of these opportunities, leaving basically the investment community, the practitioners, to make money out of retail customers. Next slide, please. Yeah. Kevin Dowd and I wrote actually a couple of papers which we've not had published yet, but they're on our website, the UMES website, if you're interested. In theory, it should be really easy to value a leasehold. It should be a function of the current rental rate, the current house price, and the term of the lease. It's really quite simple. Probably one of the simplest assets to value. But again, the industry, which is powerful and moneyed, doesn't allow that at all. And there's a very weird process which is set by a tribunal where you go in front of a judge. There'll be an expensively paid lawyer who will argue on behalf of the freeholder, the value should be this, and then the leaseholder, the potential leaseholder, will turn up probably without a lawyer or with perhaps not such an expensive lawyer as the freeholders have, and they come to a rough sort of agreement on what the value of the leasehold should be. But there are no scientific principles around this. You're going to a court. You're asking a judge to value an asset. Next slide, please. Equity release mortgages were the subject I worked with at the bank from about 2014 to when I retired. And as I said, my passing shot was that consultation paper 1318, published in 2018. 13 is the number of the consultation. That was really the last bit of work I did at the bank, and probably, in my view, the only thing of value I ever did in my entire career. Equity risk mortgage, the guarantee, there's no negative equity guarantee, and the mortgage should be valued as an option on a leasehold, as that ties into the work we've done on leasehold valuation. Despite CP 1318, which sort of roughly points you in the right direction about how to value it, in my view, a lot of firms just are not respecting that. There's been a lot of dispute and argument about it. And the current methodology is just all over the place. Next slide, please. LDI, I'll talk about that a bit when I come to the parliamentary checks and balances on that. But LDI simply involves swapping a long-dated interest rate swap for a short-term one. In theory, very easy to price because it's very easy to price swaps. Swaps are the bread and butter of the banking market. But LDI was sort of set up by actuarial consultants, and really in no way respects, in my view, how you would value one of things. Nor does the principle even make sense. Why would an insurance company turn itself into a bank, basically? But it worked fine in the low interest rate environment, which we had from 2009 to 2017 probably, and then rates sort of went up massively, as we all know, and it all went horribly wrong. Next slide, please. Right, taming the beast. I want now to talk about how we resolve the conflict between science and finance by various sort of public mechanisms. Next slide. Right, the first in theory is academia, and I think the strength of the academic world is that it should in theory be totally independent. It's either, when I was at university, it was funded by the government. I didn't pay for my education, thank goodness. Or it's funded, as of now, by student fees, neither of which party has a vested interest in enriching the financial industry. So in theory, totally independent. People in the academic world, generally the smartest people you can find on the planet, in my experience, so it's a strong intellectual integrity. And sometimes there is a public interest mandate. Anyone here who's working in the academic world would know this. You get sort of points, if you're in research and you're not teaching, you get points for stuff you publish in the better tier journals. And but also you get a sort of points, you get rewards for stuff you do in the public interest, or that's deemed to be in the public interest. And that's a good thing in my view, and there should be more of it. On the bad side, there are many cases, and frankly, it used to be argued that that universities should be more like businesses and they should get funding from the industry. I've never seen a case where that's worked out well, and I've seen many cases where it's worked out really badly. Just don't do this. And also on the bad side, academics are often remote from practitioners and not. They rely on other academics' textbooks, and they're not current with what's happening in the practice, and therefore it's often hard for them to sort of see what is wrong and write something about it. Next slide, please. Right, I worked in regulation for a long time, on and off for 20 years. And good is that in theory, regulation should be representing the public interest. It should, I'm not sure it does, have a public interest mandate. And one of the great benefits of working at a regulator is you get a team of people who are experts in the subject. And it's like a hothouse. You can work on stuff that's happening right at the very moment, and that's important, and has systemic interest or systemic impact. And you'll get a team of 4 or 5, possibly more people, possibly a whole department if it's important. And you can really iron these issues and think through them in a way that is not possible for all the other backstops that I'm going to discuss. So that's on the good side. On the bad side, there's a huge dependence on commercial interest. There's what's called regulatory capture, where the people you talk to, often on very friendly terms at the regulated firms, will sort of persuade you. You'll just in virtue of talking to them and being on first name terms with them, you'll be sort of captured. You'll be sucked in some way. And look, yeah, we just had the stock press. We're seeing we're sitting right in the middle of a banking crisis. Silicon Valley Bank was a regulated firm. It was regulated by still is, by the San Francisco Federal Reserve. It looks like what they were reporting bore no resemblance to what they should have been reporting. The risk was far too high for anyone to reasonably accept, yet they were allowed to do that. And there are stories coming out in the press about how they were trying to influence, they were lobbying, there was political pressure on the regulators and so forth. Regulatory capture is a really big deal. Difficult to know how to do something about it. How do you regulate firms like policewomen? Very hard. And while in my view, there should be a public interest mandate, there should be something for the regulator to say, yeah, it's the people that matter the most. It's the retail customers that matter the most. That in my view does not happen. I remember clearly an assessment. You have an annual assessment, and my manager said, "Well, Dean has a clear interest in Dean is always pointing out how the public interest is important, but perhaps he is too much interested in that." Next slide, please. Yeah, now there are various judicial mechanisms which allow sort of retail customers to get sort of to the truth, to ensure some kind of fairness. One is the transfer of annuity business under what's called Part 7 of FSMA, the Financial Services and Markets Act. There's also, I'm not going to talk about this too much, the leasehold tribunal process, because I've already talked about that. This is where you want to extend a lease or to buy the freeholder out, and the freeholder will naturally want as much as they can for this. So you'll go to this leasehold tribunal where there's an expensive lawyer on the freeholder side, less expensive, or no lawyer on the leaseholder side. Again, that's meant to be a protection. It was put in place as protection, but it doesn't work in my view. And then on the transfer of annuity business, this is where one firm that holds pensions is transferring to another firm. And essentially, it's in the interest of the policyholders that they have the best company, or in particular, in the case of Prudential Assurance, the company they chose. There are 4 theoretical layers of protection. There's the judge, the independent expert, the regulator, and the policyholders have a right to be heard. They have a right to stand up in front of the judge and say, this is why I don't want my pension to be transferred. However, on the downside, it's a really expensive process. For very large transfers, and the Prudential to Rothschild transfer was one such, there are whole armies of solicitors and a barrister, actually 3 barristers, who are appealing to the judge. And these are very, very highly paid and very highly qualified and highly competent lawyers, who are working in the interest of the transferring firms in the industry. On the other side, the policyholders do not have much. The independent expert is appointed, and I think paid for by the transferring parties. So in theory, the expert should be working in your favour, but my suspicion is that they aren't. The annuitants can stand up, and I've had experience of, I think, 3 transfers of this sort. Annuitants, I'm sorry to say this, don't have a clue. They have no expertise in the science of finance at all. Why would they? Otherwise, they'd be working in finance. And also the various legal niceties of process, which I learned about by being involved in these, which sort of make sense if you understand them, but policyholders won't understand that. The process is entirely, in my view, biased in the interest of the transferring parties. Next slide, please. Yeah, there's something else called class action, which in theory it's not relying on the government or the regulator or anyone else or a judge being nice to you. It's based on pure self-interest. The US model is this, that someone will fund a group action or a class action, it's called. And they'll basically use a speculator who will make a bet. They'll make a bet that the judge will award in people's favour, in the appellant's favour, The appellants will get compensation, but the funder, as a reward for sort of helping them with their legal costs, will get between 20 and 40% of that compensation. So the good thing is that the victims will have full and proper and expensive legal support from someone whose interests are entirely aligned to theirs. That's a really good thing, and probably the only case of that happening. On the bad side, well, you see the same bullet point appears twice. 20 to 40% of your compensation goes to some sort of fund manager. And also, I believe customers of unregulated providers have no right to a private action anyway. Next slide, please. Right, professional. Now, what I mean by professional is that there are all sorts of paid servants, if you like, of the commercial interests. I'm thinking primarily accountants, actuaries, yeah, probably those. These are professional advisors, and there's a point, their advice will tend to favour the people who are paying them. On the other hand, there's a limit to what they can go. They can't do something that is that's either outrightly criminal or obviously unfair, because that impacts on their professional reputation. And reputational risk is important to all professions. They must protect their reputation, and there is a limit to how far they can go in the direction of not protecting their reputation. So that's a good thing. On the bad side, most professions are a form of restrictive practice. So I remember in the 70s, this sort of disappeared in the case of sort of ordinary workers. The idea that a union could say you can do this but not this is not a good thing, not in the public interest, and that was largely sort of weeded out. And I remember Margaret Thatcher wanted to do exactly the same thing in the case of these sort of middle class professions, in case of the law, accounting, and so forth. That didn't really happen. Now, you'd hope you're getting the best people, because it's in the profession's interest to have a set of examinations that test people to make sure they're the right sort of people. But my experience is that these examinations are simply guaranteed. They simply force a pass rate of 15% or whatever. There'll be a wide number of questions which are sort of wide but shallow. They don't really test very much, and the whole point of the system is to allow only 15% of people who take the exams in any year to get through. And also there are many cases where people who have felt that the profession wasn't working in its best interests, and they spoke out in some way against commercial pressure that they'd experienced. There's a horrible process. I would recommend no one to get involved with. Don't blow the whistle. It's not going to help you. It will damage you and your career. And until the law is changed, I would not recommend it. Next slide, please. All right, the press. Again, that's another institution which has no real commercial interest. It appeals to its readership. The readership pays for what they want to read, and the readership will naturally have a healthy suspicion of vested interests. And pretty much all journalists, and I've worked with many, are really just brilliant at explaining something, a complex issue, in a clear way. I'll go to journalists and say it's like this, and sort of explain the technicalities with Greek letters and so forth, and they all sort of throw all that out and come up with some really brilliant and clear explanations of what's going on. So the press is good in that respect. Bad is that, well, advertisers pay for the media in most cases, and obviously there'll be commercial interest in advertising. Most financial issues are really complex. Again, journalists are very good at explaining complex issues, but sometimes you'll present a journalist with something, they'll just walk away. They will see that they can't explain it, so why should they? Press often, as we know, has a herd mentality, and I think the whole sort of disintermediation that we've seen over the past 20 years with the internet has not been a good thing. I think whatever the vices and evils of the old sort of Fleet Street, at least you had people who were employed and often highly paid to defend the public interest. So we have no one really like that now. And I think the internet, I may be wrong, but I think the internet has reduced the power of the media and therefore been a bad thing. Next slide, please. Right. In theory, the government's elected by the people. The government has an interest in not upsetting people. It's sort of accountable to it. So that all works in theory. Bad. Well, the civil service is the instrument of the government, and it often has its own agenda. I recommend looking at the Wikipedia page on Sir Humphrey. If anyone remembers, yes, Minister. And that's a great page on Sir Humphrey's sort of mentality, which is the archetypal senior civil servant who uses language as a tool of confusion and obstruction, which is so deeply ingrained that he's sometimes unable to speak clearly and directly, even when he honestly wishes to be clearly understood. That very much my experience of working with colleagues and civil servants. Well, once someone even told me, look, this is very clear what you've written, Dean. It's really clear. It's far too clear because as clearly as that, there's a clear legal risk that someone will come back and say, well, actually, you said you were going to do this, but you haven't, and we're going to sue you. And that is why civil servants speak the way they do. The whole bureaucracy is there to protect itself, not to protect anyone else. And anything that looks like it could be creating some sort of risk, simply by speaking clearly and properly, will be resisted. Next slide, please. Parliament, right. I've worked with a number of, well, two parliamentary committees. These, again, I think were set up by Margaret Thatcher in the 1980s. The parliamentary committees have a right to challenge government. So they have the right, and remember that government is not the same as Parliament. Parliament sort of supports or resists government, but parliamentary committees are run by parliamentarians, and they have the right to challenge the government and civil servants. So the Treasury Committee will regularly haul up his poor civil servants or bureaucrats from the bank, His Majesty's Treasury, like the Treasury Committee and the Work and Pensions Committee, and they do a very good job in sort of making these people accountable. That's all good. I think it's a great institution. Bad is the complexity issue again. My experience is, and we have sort of privately briefed the members of the committees who are parliamentarians, not technical experts. We briefed them on what they should be saying, what the questions they should be asking, and the likely answers, and how to defend themselves against those likely answers. But the problem is, in the heat of the moment, you've got very smart people on the bureaucratic side. You get the Sir Humphrey there, who is totally expert in understanding perfectly the question and understanding how to avoid it or evade it or change the subject. Also, the committee will rely on, it will sometimes sort of challenge experts or call experts to advise it. But the whole problem with experts is that you as a non-expert don't have the expertise to distinguish true experts from false ones. False expert being someone who's not really it's a bit like a fake diamond or fool's gold. A false expert is not an expert at all. And that really is a hard task to distinguish. And I think the LDI, the liability-driven investment affair, was one such case. There were a series of people sort of called up to answer questions from the committee, and some of them were absolutely bona fide and clearly knew what they were talking about, and rightly so, and were not, were not in the arms of the industry, but others of whom were not so far. I won't say any more on that subject, but there is the problem. There is a problem of a non-expert, like a parliamentarian, deciding who the true experts are, or who the experts are. Next slide, please. Yeah, commissions. I did a bit of research on this, including speaking to one person who'd chaired a commission. Commission is what it says on the box. It's literally commissioned by some authoritative body. And the key to that is the authoritative body. I mean, I could get some money out of my bank and pay someone to make some sort of pronouncement on something. And that's a commission, but the key is it has to be by a body that is generally accepted as having authority. And that's a problem because normally the authoritative people or bodies will have some sort of skin in the game. It always happens after something bad's happened, and it never happens with foresight, always with hindsight. And of course, that's a bad thing. So the good thing is about the commission, the findings of a commission can change things for better. But the problem is these things never happen before the event, always happen afterwards, and of course, as usual, are vulnerable to lobbying by the usual suspects. Next slide, please. I've sort of covered independent experts. A truly independent expert is clearly independent, but as we saw in the case of the Part 7, the experts will be employed by vested commercial interests. And as Upton Sinclair said, it is difficult to get a man, or a woman, should have said, to understand something when his or her salary depends on his or her not understanding it. Very funny, but very true. And finally, next slide, please. I think it's the final slide. Yeah, as I said, complex matters tend to have less scrutiny than simple ones because they're too complex. It's very hard to get people to get interested in something that the first page causes their eyes to glaze over. Also, simple matters tend not to end in disaster because they're simple. If everyone in the world can see, look, this is clearly wrong, then something will be done about it. But something that is truly complex and difficult to understand, and only understand by the most vested experts, will not have the scrutiny it should have. Another final slide. Next slide, please. And yes, there's a superstition about money. You go to a dinner party or a party and you try and talk about interest rate swaps. You know, people will fall away. You'll soon be on your own in a corner. So there's lack of interest, and that's just the superstitious side. People believe that money is sort of very, very complex and difficult, so they avoid it. On the other hand, they believe that there are people who are going to work in their interest and will help them. And the entire fund management and financial advice industry is based around that. People remember Neil Woodford. They believed, in fact, people close to me and myself believed in this. Woodward had a stellar reputation and a record, and people invested in him, and he managed to lose more money of a greater percentage of his portfolio than anyone in the history of finance. And it's hard to see how to get over that. If superstition is very hard to eradicate. Right, next slide, which is the question slide. So I'll throw that open. It's 12:48.
Okay, fantastic. No, thanks a lot, Dean. This has been a really interesting analysis. Perhaps I could start with a question while we give the others an opportunity to gather their thoughts as well. So, I mean, tapping into your experience as a regulator, regulators are often very good at regulating for the last crisis. That tends to be the way these things play out, and that there are sort of good reasons for that, and potentially some bad ones. You know, thinking about what the FSB did in light of the 2008 crisis with the too big to fail reforms. But now we're seeing regulators look at potentially be a little bit more preemptive in their thinking. You know, we're seeing discussions around central bank digital currencies and stable coins and lots of interesting developments in the fintech space. So I suppose my question is, are regulators regulating in a sort of a modern way that makes sense to you? Are they getting better at what they do, or are essentially they still stuck in the same patterns and making the same mistakes, which are, you know, being very retrospective, I suppose?
But very much the latter. You know, I've been working in this space for 20 years. I remember the 2001 crisis, where stuff sort of this was just a stock market collapse, and then everyone was told to be forward-looking, not backward-looking. That sort of thing went round. There were lots of sort of internal seminars on how to do this, and then the GFC happened, the Great Financial Crisis, and you know, then you put your Harry hindsight spectacles on, and you see, we should have been looking at that. Wind forward a bit, there's all sorts of stuff going on. The industry wanted to get as much leverage as it could, and it got it. And, you know, then we had LDI came out of that. And right now, as we speak, I haven't looked at the markets right now, but I can see my banking shares have collapsed. And it's looking bad in the States. Why on earth did that happen? Why was the regulator not looking at that? The evidence so far, now hard to comment now, the evidence so far seems to be the regulator just ignored it because it was not in its interest to do so. So very much, there will always be another financial crisis, but it will never be in the place that you were looking at last time. So I'm a bit of a pessimist on that. So we've got Jane Hutton, hand up.
Shane, go ahead.
Thank you, Dean, for a very cheering discussion. Two quick points. When Basel II came in, I think it was 2 or 3 academics wrote a paper in 2000 predicting the 2008-9 financial crash. So, well, of course, that was ignored. So when the Queen said, why did nobody predict this? The answer was, well, they did. But of course, statisticians didn't feature too highly. The second thing is that about a year ago, 18 months ago, I organised a workshop at the Isaac Newton Institute on maths and stats for effective regulation, in which there was a comparison of what's happened in medicines and medical devices, statistics and the law, and the financial sector. And I was hoping for some cross-fertilization. The pensions regulator, of course, was the only participant who refused to contribute anything in the public. They believe that their regulation should be entirely opaque and nobody should be allowed to ask any questions about it. What's your view on A, what you can learn from regulation of other areas, and B, openness of regulation and implementation of regulation?
Right, that's a big subject, Jane. I'll try and give us sort of clear but short answers I can. On the first question, you mentioned 2 academics who predicted Basel II, wasn't it? That's the right number.
Yep.
Would end in disaster.
Yep.
Now, that's interesting because it's a kind of law that when any crisis happens, there will be people coming up and saying, as with the LDI crisis, I think there were 2 people, quite important economists or practitioners who'd said, yeah, we've been banging on about this for years. This always happens. Any disaster happens, there will be people who come forward and say...
I think the fair comment would be to look at the actual academic paper, putting out the reasons for it,
yes,
rather than just saying, oh yeah, there are lots of predictions and one of them will come true.
No, they're quite right. The people who come forward and say, look, we've been banging on about this rightly, and yeah, genuinely rightly for years, will have been ignored. And that's the problem, that there's always a whole load of stuff out there. Plus regulators and practitioners rarely look at academic papers. That's a fact. I worked for a long time, for about 4 years, on the whole equity release mortgage fiasco. And, you know, I was told, well, this is just economics, and we all know that economists have 2 hands, is on the one hand, on the other.
Why is it so different, do you think, in regulation of medical devices?
I don't know much about. I don't know much about medical regulation, so I can't really answer that.
I mean, that was what I was trying to encourage, was that regulators perhaps look beyond their own silos.
Regulators should look beyond their own silos, but they rarely do. And the second point was, or was that? Does that cover the second point?
I think it's probably covered those sorts.
Yes. I'm just generally pessimistic. There's, as I say, there's regulation and there's practice and there's theory. And neither of the first two tend to look at academic papers, often because they don't understand them. You know, there are a lot of, yeah.
As I say, I mean, whether there is any scope for, in the long term, from this section of getting more statistical academics involved, as has happened in the.
That would be a great thing. I think that would really be a great thing. But will it happen? And it's not within my gift to sort of to say it should happen anymore. All I can do is bang on the table from time to time. Yeah. We have occasional meetings with the regulators, and we.
Yeah. Thank you.
We say what we think, but do they listen? Who knows? Thank you.
Thank you.
It's been a long challenge, hasn't it? Regulators and academics working effectively together, and trying to best utilize each other's expertise. And yeah, I think everyone's trying to. Well, I would like to think everyone's moving forward in that space and looking to improve things. And I suppose that comes to my question here. And amongst a general sense of pessimism, I dare say, is there any source of optimism in amongst it all? Is there an area you feel is moving very much in the right direction? And if we were to maybe shift our focus further towards that direction, we may be moving, closer to, I suppose, a future model that looks slightly more rosy.
I always had a dream that there would be some way of getting. The way you could make it work is to get an independent panel of experts with authority, and that's really important. It's not just for me or someone, or even a couple of academics to stand up and say what we think. That body would have to be totally independent. It would have the right sort of expertise, and it would have authority. Now, if someone could put their mind to that from whatever quarter and get something together and do that, it's not impossible, then that would be a great step forward.
Did anyone have any final questions here? I'm conscious of the time.
Well, I was just going to say, Dean, if you're serious about that, drop me an email. You can just put Jane Hutton into Google. It should find me, because it is something I've got at the back of my mind to work on.
Brilliant. I'll do that. Thank you, Jane.
Fantastic. Okay. Any last questions? Feel free to raise your hand or write in the chat box.
I can see some friends here, but I haven't. They know who they are.
Shy friends. Yeah. Okay. That's okay. All right. Well, that's great. I guess we can bring this to an end then. Yeah, really like to thank you, Dean, for
thank you for the invite.
Analysis.
Yeah, and I hope you can publish this somewhere. Would it go on YouTube or something like that?
No, it's our pleasure. And yeah, absolutely. Our intention is to put this up on YouTube. We've done that before with a couple of our other sessions as well. So it'll be up there and it'll be on the internet forever, whether you like it or not. So
thank you very much. And thank you to everyone for attending. Thank you.
Thank you, everybody. And wish you a great rest of the day.
Have a great weekend.